following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, welcome back to Options Bootcamp, and I love that music. It really gets me in the mood to do some hardcore options training. I have my hat here and my whistle. I'm all set. I'm ready to go. My name, of course, is Mark Longo from theoptionsinsider.com, as well as the Options Insider Radio Network. And before we start the show, a quick plug. If you're going to be in Chicago next month, May 15th to be exact, we'd love to see you down at the Chicago Board Options Exchange. The Options Insider will be holding our first of hopefully many to come, our first unusual activity forum. It's going to be down there at the CBOE. Dan's going to be there. If you like Dan on the show, if you haven't had enough of him already, then by all means, you're going to want to see him there at the Unusual Activity Forum. Bunch of other great educators and experts from the world of options and analytics and trading and data. So we have a lot of great stuff going on. Throwing in a floor tour, a bunch of great freebies and software. You even get a month of Dan's group coaching included. All that for $99. It's kind of ridiculous. We really did go over the top from a value perspective. We want to make sure for our first big paid premium event, we want to make sure everybody comes, has a great time, learns a lot of great stuff, and gets a lot of bang for your buck. So if you're going to be in Chicago on May 15th, we'd love to see you at the CBOE. If you'd like to learn more, surf on over to theoptionsinsider.com/events. You can find out all the information there and click on the tabs to register, and hurry up and reserve your seat because we quite literally are running out of space. So by all means, if you're interested in coming down, you're going to be in Chicago, we'd love to see you. And speaking of Dan, I am joined on this fine program by my fellow drill instructor, the Major Domo over there at Market Taker Mentoring, a.k.a. the man in the black hat, none other than Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the show, sir.
Yeah. What's up, Mark? How are you, my friend?
I'm good. I'm excited for this big shindig we have coming up next month. Are you excited, sir?
Indeed. Yeah, that's going to be really fun. I'm really looking forward to it, and looking forward to meeting some of our listeners.
Yeah, that'll be fun to see people in the flesh who actually can ask us questions in person as opposed to just shooting them in on the radio. It's fun to answer them on the radio too, of course, but we love to answer them in person as well. And if you like, on some of the things we hit on this show, this segment's going to be a little bit more advanced, but it's really going to be, we have some people writing in saying, is it aimed at a certain category of options traders? If you're pretty new, you could still understand a lot of the things we're talking about. And we'll also give you, of course, some things to think about for the future as you're planning your options trading. So don't worry if you're kind of just learning options, if this might be too intimidating for you. I guarantee you we'll make it something that you can appreciate as well. And speaking of things and people that everyone can appreciate, we are also joined by the man holding down the options fort over there at Sogo Trade, good old John Critchley. John, welcome back to the program, sir.
Howdy, folks. How's everybody? I just got done dealing with a mini flash crash today. There was supposedly AP Twitter account got hacked, and somebody threw out there that the White House was bombed, and we had a big dip about 40 minutes ago in the S&P and the futures. So I'm just done dealing with that, but I'm ready for the podcast. Should be a lot of fun.
That's what I get getting busy preparing for a show. I didn't even have a chance to see that, so that was good. It insulated me from trying to dive in there and make some trades. But that just shows you how vulnerable we are to this kind of thing. Hacking something as simple as hacking a Twitter account, which I think any 13-year-old could do, really is enough to set off this kind of panic across the board. So yeah, as we're recording this today, listeners, most of the major indices back in the green territory, up about 1% on the day. So perhaps the rally has begun. And of course, the show has begun because it is time for our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Call in. Prepare to learn. Yes, sir.
I always feel so patriotic when we dive into this segment. I really don't know why. I can't explain it, but I just get that throbbing in the old throat thinking of God and country and all that fun stuff. Of course, this is indeed the basic training segment. This is where we take you, the basic retail options trader, and we teach you some new tricks, some new things you can do in your portfolio to help improve your returns using options. And we hit on a bunch of different concepts on this show in the past, and we were thinking about what we can talk about today, and it kind of came down to an interesting topic, certainly a relevant one, given everything that's going on in the marketplace right now, and of course, this crazy little dip we had today as well. It's the topic of playing defense using options, and that's really an important use case for options. One that's really overlooked. When you see a lot of the mass media talking about options, they get into the speculative aspects, they get into the leverage aspects, they get into writing options into the camp of being very dangerous derivative instruments and all these things. And a lot of this attention really overlooks the fact that the primary use case for options, at least the intended use case, is for defense, for hedging, for protecting your portfolio. So we're going to get into a few different scenarios for that today. Now we'll kick things off with a very basic topic, the defensive/protective put. If you remember, if you've been listening to our show for a while, we hit on this back in episode 3, way back, about a year ago now, I would say. So if you want to get a full overview of the protective put, then go back in iTunes or on the optionsinsider.com, wherever you listen to this program, and listen to episode 3 again, because it'll give you a good overview of the protective put. Really quick, if you haven't, really quick, if you're just tuning in to us for the first time, a protective put, a very basic options position. It's where you own stock. And by the way, I should lay out that all of these defensive strategies we're talking about today, all of them are going to be used in conjunction with stock, because we know that's what most of you are looking to do. You're looking to defend stock positions. So the protective put, pretty much the most basic options defensive position. You own XYZ stock, let's say for $100, or it's trading at $100, and you say, I really don't want this stock to drop much below 95. I'm going to lock it in at 95. So you go out and you buy a 95 put for $1. So now you've essentially locked in that floor for that stock of $94, which is the $95 strike price minus the $1 you paid for the option. Very quick overview of protective put. Like I said, if you want to learn more, a full overview, go back to episode 3. But that is the very, very basic strategy that most of you, I think, will entertain when first thinking about how to defend your stock positions. Now, it gets a little bit more interesting from there. There's a couple of different things you can do once you've mastered the basic put. And I think what a lot of our listeners like to do, particularly in some of our more intermediate to advanced shows, and what I'm sure Dan and John like to coach their clients and customers as well, is to take that put spread and do some interesting things with it. And there's a couple of things you can do. You can, of course, go to the old put spread. And that is a way, because the common pushback we hear from people whenever we say, hey, you should defend your stock portfolio with protective puts, is, oh, it's so expensive. I don't want to pay all this money for these puts. There is a way to get around that, at least some of that. And that is by using ye old put spread. And Dan, I'm sure when people come to you over there at Market Taker, you probably counsel a lot of them to start using put spreads and perhaps even the old ratio put spread. So why don't you walk our listeners through both of the ways they can augment a simple basic put and turn it into a put spread and even a ratio put spread?
Sure. This stems from the idea that buying puts can be expensive. And, in the long run, just buying puts month after month after month turns out to be a losing proposition. It's one way to guarantee that in the long run you lose if that's all you do is just buy straight puts month after month. But buying a put spread can be a way to finance a put. And the idea is this. You own stock. You buy your protective put, just like you normally would. But to finance that, you sell a lower strike put. Now, this does a couple of things here. It kind of has some benefits and detriments, I guess, if you will. For one, the first thing that it does is it gives you that long put. And it finances that put by making your cash outlay for that insurance policy cheaper. Now, the second thing that it does is kind of a little bit of a detriment, I guess, if you will. It limits that amount of protection. So when you do have a big flash crash, the market just drops, 10% in a minute like that, your protection is limited. So I counsel people, as far as just the straight buy a put, sell a put, I counsel my students, if you're really looking for disaster insurance, you might want to either do one of a couple things. Either just go with the straight put this time right now, again, not month after month, or make sure that the width between the two strike prices is pretty wide, because the closer together the strike prices are, the more you limit your protection on that insurance element. So another thing that traders can do is finance that protection even more. So instead of just going and buying one put against your stock and then selling another put to finance it, traders can go and sell two puts, or potentially maybe even more puts. Now, what that does is that can enable traders to finance 100% of the cost of their put. So let's kind of put some numbers on it here. We own a $50 stock, and say we buy the 45 puts at $2, and we sell two of the 40 puts at $1. So how much is the cost of our protection? Well, it's zero, right? Because we paid $2 for the protective put, and then we collected $2 in selling those lower strike puts. So if the stock falls some, our insurance will cost us nothing and can be effective unless the stock falls down below those two short put strikes. That's when, we could end up getting assigned on those puts if we, happen to leave that trade on all the way until expiration and blah, blah, blah. I mean, obviously, when you're doing something like a ratio put spread like that, you have to kind of manage it and pay closer attention to it. But, again, that is just kind of one of the options out there that we have for kind of financing some of our protection.
Yeah, it really comes back to, again, what your near-term outlook is for the position. If you're trading right now the markets are approaching all-time highs again. We're rallying a bit again. And if you're worried about some little near-term jitters here or there, then something like a put spread or even a ratio put spread is something you could consider. If you're worried about the apocalyptic end times and the big meltdown that's going to wipe the S&P out by 50% or something like that, then you really have to have a bit of a more open-ended approach to your protection on the downside there. And that's where something as simple as a protective put is probably your best option, pun intended, because it gives you the most protection to the downside. So again, these are some interesting topics. If you want to learn more about spreads and things like that we just talked about, go back, listen to our episodes on spreads where we hit on those in great detail. Again, these are kind of essentially overviews of some really interesting and effective and simple, for the most part, defensive strategies that you, a basic retail options trader, can implement right now in your portfolio and see some immediate benefit from them. Now, the next one we're going to hit on, not really defensive. Some people think of it that way, and if you do think of it that way, then perhaps you should go back and listen to our episode on synthetics. That was a recent episode within the last few, so go back, listen to our episode of The Joy of Synthetics, I believe we called it, where we'll discuss this strategy and some of the misperceptions behind it in a lot more detail. But really, what we're talking about here is a position known as a covered call. Like I said, we've hit on it before. We also we touched on it in episode 4, selling options. That's where we first hit on this concept. Covered call, a very popular topic. Of course, you own an underlying, you own some stock, XYZ stock. You want to generate a little bit extra income on it. You sell a call that's 5% out of the money for, let's say, $1. So now you've collected that $1. If the stock rallies to that strike, you get all of that appreciation plus the $1 you sold. It's a pretty good trade for those types of scenarios. If the stock drops, you get $1 of cushion, which is more than you had before. So in that sense, there is a modest defensive element to it. But the real reason I bring it up is, and I bring up the protective puts today, is not because we want to look at those strategies in detail, but really because we're going to talk about a way you can use both of those strategies in conjunction to really create this super transformer, this super Voltron of positions where you combine the protective put and the covered call into one beast of a position. And this is really what we're going to talk about today. And that position is called the collar. Now, if you're looking around these days for a financial advisor or someone else who can use options to help protect your portfolios and generate some income for you, the vast majority of them, if they are using options, which is, of course, remember, a very small percentage of financial advisors, but if they are using options, the vast majority of them are trading collars. So if you can learn to construct a collar yourself, you're really ahead of the game. And you pretty much, may not even need that money manager, that financial advisor. You can end up saving yourself quite a bit of money. So let's walk through what a collar is. Very simple strategy. You own underlying stock, XYZ stock. Let's say it's trading for $100 again. Everyone loves to buy XYZ at 100. I don't know, just everyone's favorite price level. So let's say now you're worried, well, I don't really want this stock to drop below 95. So I'm going to go out and buy that 95 put again, and I'm going to pay $1 for it. So now you've paid $1. So that's $1 you've paid. That only lasts until the amount of time that option expires. And so you're saying to yourself, wow, I just spent a lot of money on this protection. It only lasts a little bit of time. I don't know this is really viable for me in the long term. What are some ways that I could offset this protection and then this amount that I'm paying for my insurance on my portfolio? So you start looking around, you see that, the 105 call, also trading for $1. Now you say to yourself, well, I'm happy selling this stock at 105 if it does rally to that level. So I'm going to turn around and sell that 105 call for $1. Guess what you've just done? You've just constructed a collar. You've bought a put for $1. You've turned around and sold a call against it, essentially for $1. Now you've set up a position where if it drops below 95, you are out at 95. So you've set up a floor for yourself at $95. At the same token, if the stock rallies to 105, you're out at 105. So you're surrendering some of your upside in the position. So this is very much for a position where you're concerned about near-term fluctuations to the downside and to the upside, but you're not really expecting a massive bull rally in that underlying. If you are, there are better ways to construct this. But this collar is a universally popular, universally common technique, and a very, very viable one for a lot of you out there who are trading stocks and looking for ways to protect them on a more affordable long-term basis. And John, I'm sure people call you up all the time over there at Sogo asking about asking about covered calls, asking about protective puts. And I'm sure you spend a lot of time walking them through that combination, how to put the two together to create the collar. Is that something you do on a regular basis over there?
We that's one of the most popular strategies, of course, is the cover call. And what Mark hit on was something that is a collar, but it's a zero cost collar, and that's wonderful. You pay zero to put the collar on, and you're protected in the downside and the upside. If the stock rallies, well, you have to sell the stock, but you're going to be happy selling it there. They had a study that was done a few years back by the OIC, and it was a 10-year study, and it showed that this strategy, using 6-month output purchases and consecutive 1-month call rights or call sales, earned superior returns or better returns than a simple buy and hold strategy. And it also, this is really the kicker, it reduced the risk by almost 65%. So a lot of if you want to do some asset allocation or if you want some protection, this is a wonderful strategy. And the only risk you have is, I think in my head, is always a psychological risk. Customers say after they put it on, they're protected. And then one day we have an event like Netflix today, and then Netflix goes up 40, 50 points. And they had a collar on, and now they're selling Netflix at 200, now it's 220. And I get the call, look what happened. But believe me, long-term buy and hold customers, this is a wonderful strategy.
And it can be a pretty versatile strategy too. On its most basic level, the collar is pretty simple. You buy your put and you finance it with a call. But I talk to some of my students who are, more investors as opposed to traders who are doing things like collars. I talk to them about a strategy where you buy a somewhat longer term option. I mean, not like a leaps or anything like that, but maybe say a 3-month put and then sell a 1-month call, or maybe even, some of the serial weeklies calls, so that you can take advantage of the higher rate of time decay. Now, that's maybe not for the basic investor. That requires you watching these a lot more closely so you don't end up getting assigned, and it requires a little bit more management and a little bit more options knowledge. But that's just sort of another alternative that is out there for investors looking to hedge with collars.
I mentioned in my example what John said, which is, of course, the zero cost collar. My proverbial XYZ example ended up being no net outlay. And that is what a lot of people tend to pursue, and that's what they look for. They look for that zero cost collar, which is why I use that as my example. But I would caution you listeners not to make that your goal at the end of the day, because when you're setting up a collar and your only purpose in life is to not pay anything for it, you end up perhaps going through some convoluted lengths to make those strikes work out and those prices work out. You're probably going to end up buying a put somewhere on a strike you really don't want, not getting all the protection you want, selling a call somewhere you probably don't want to, so maybe clipping your upside a little bit more than you want to. John mentioned the OIC study, and of course we've talked on this show many times about time decay and how that impacts your portfolio. Again, go back to our episode on the Greeks if you want to learn more about that in specific detail. But apply those lessons we've discussed on our earlier episodes when you're constructing the collar. Because remember, the optimal position for buying that put is really more of a longer term buy. You want to roll it out. The OIC found in their study about 6 months, but anything 3 to 6 months I think should be an optimal combination of premium versus protection. If you go much beyond that, you're paying a lot more for not much more protection, where if you start going much shorter than 3 months, you start trading front month puts or indeed weekly puts, God forbid, for protection, then unless you have a very specific event you want to hedge against, then you're really going to be paying nothing but time decay. And that's what usually ends up happening when you're constructing these zero cost collars. They usually are in the same month. And so you're forced to trade strikes in the same month, and create a position that probably is less than desirable. Where if you're really creating a collar to maximize the benefit, you want to roll out that put position a little bit and make sure your call sales are as near term as possible. Maybe in the weeklies, definitely in the front month at the very least. So what you're really looking at is a position with a long underlying component, and then a protective put component somewhere in the 3 to 6 month range, and then a covered call component that is somewhere in the weekly to 1 month range. So obviously that takes a little bit more work. You have to roll the calls every month to catch up to your put and then roll it again. So it's not all going to expire in the same month. So there are some benefits to wrapping all this collar up into 1 month in one simple, easy little package that's easy to understand. And maybe for some of our beginning listeners, and maybe that's the easiest approach to take, but on the flip side, you're not maximizing the returns. If you start taking a position with a little bit longer term put and a near term call and keep taking that approach to it, you're going to have a net outlay at the beginning for the collar. That's a guarantee because you're buying a longer term put. But at the end of the day, writing those consecutive calls, you could actually end up collecting more and at the very least offsetting that put to a higher degree than if you just do front month every time, because remember, you're paying a lot of decay on that put, even though you're collecting it on that call. So zero cost collars are nice when you can construct them properly, but really the optimal collar is more of a combination of a little bit longer term put with a little bit shorter term call. And John, I can hear you blowing your whistle there in the background because you have something else you want to throw into the collar discussion. So have at it, sir.
Well, the one thing I wanted to mention, I just wanted to go back. I should have mentioned earlier about the protective put. If it's very important for our listeners to actually listen to all the shows, because if you remember, if you're long the stock and you buy the protective put, what are you really doing? It's a synthetic call, and we went over that already. So if Apple's 400 and you own the stock and you buy the 370 puts, what are you in essence doing? You're buying the 370 calls. We went over this in the last show, stock replacement, and a stock replacement can also, and we mentioned this very clearly in the podcast, can be defensive also. It puts a floor also on how much you can lose. So I just wanted to bring that up. I should have brought it up earlier, but I think it's very important for our listeners to go back and go over the synthetic episode and the stock replacement episode, because some of those strategies, they all tie in together.
Yeah, I hit on that earlier in the show, and I didn't have the episode number. I do have it now. That is episode 18, which came out on March 6th, The Joys of Synthetics, where we walk through exactly those concepts and how instead of expending all the outlay to buy the stock and buy the put, you can instead buy the call, save yourself a lot of hassle and a lot of money. So that episode walks you through all that. Remember, the title might be a little bit scary, synthetics, but really it walks you through the much more efficient ways to utilize your capital when combining stock and options in some way, shape, or form. Now, we've hit on the creme de la creme of the protective strategies, the collar, which so many people return to on a regular basis, and that really is what a lot of people like to use, whether you're an asset manager, financial advisor, what have you, to protect a long equity position. That's really where the rubber meets the road for a lot of people. But there are other alternatives floating around out there. Some of you may have heard, listeners, that there are these products out there called Volatility / the VIX. And I'm joking because, of course, you've heard of those. These things are marketed all over the place. If you're listening to this show, if you're in any way cognizant of options, then you've probably heard of the VIX. They hit on it on CNBC about 70,000 times a day, also known as the fear gauge. And if you've heard of that, you've probably also heard the oft-repeated and not entirely true concept that the VIX is this perfect one-to-one hedge and that volatility is this perfect one-to-one hedge with the underlying. So if you believe that, you might think, well, this is an ideal product to use to hedge my portfolio. So if the underlying drops, volatility, of course, is going to rise one-to-one, and I'm going to be perfectly hedged with my volatility product. Now, John, I'm sure a lot of people call you up over there asking you about VIX and volatility products, including that, repeating that phrase to you that VIX is a one-to-one hedge. So why don't you walk our listeners through some of the pros and the initial concepts of volatility hedges, and as well as some of the cons of these products?
Well, the one major thing I want to bring up is that there was another study done that for over the past 20 years, the VIX has moved in the opposite direction of the S&P 500 88% of the time. And then when the underlying market has suffered a retracement, let's say 3%, the VIX has typically risen by about 17%. So the VIX, if used properly, can be a great hedge, but the customer, and we always try to tell them to really study up on it and really get back to the basics, and that it's not a perfect hedge, but I think that you can use the VIX if you're going to use it on a short-term basis. I think it's a great hedge, 1 or 2 day, but I've had cases where customers have bought some VIX calls and, the market will go down, the VIX calls will go up, and the next day the market goes down, and the VIX then the calls seem to underperform. So there, the days where the VIX is going to really outperform would have been a day like today, or a big black swan or outlier event. But the VIX is actually is a very popular trading instrument, and it should be, because it provides short-term hedging, not perfect, but pretty good, and a lot of customers do use it, and if you don't use it, you should consider using it as a hedge.
Yeah, John said it all. I just kind of want to expand maybe a little bit on a couple of things. I'm with you. I think the VIX is an awesome product and can make an excellent addition to a conservative investor's portfolio. But, you got to be careful, and you got to really appreciate the sophistication of this product. The fact that 87% of the time the VIX and the SPX move in opposite directions, that's like you buy insurance for your car and they say, well, 87% of the time we're going to pay your claim. The other 13% of the time, So, you've got to really appreciate these differences. Otherwise, you can end up really unpleasantly surprised. And I've had students, I had this one student who had a very, very concentrated amount of his wealth in Apple stock. And he came to me and he said, hey, Dan, I need you to teach me how to hedge with this. And I'm very interested in using the VIX or the VXX in order to hedge myself. And I said, well, maybe we should start thinking about puts and collars and that kind of thing.
Yeah, start with puts first before you dive into the VIX with Apple. That's a good one.
Right. And, I explained puts to him, and he didn't, I mean, it was his first exposure to options. He didn't really get it that much. I mean, which is acceptable. I mean, expected, I mean, nobody just masters options after a 15-minute conversation. But, I really had to work with him to understand how just buying an Apple put can help you. But he really wanted to trade those VIX and VXX options against it, and, if you're struggling to understand puts, you're playing with fire if you're hedging with the VIX and VXX.
And how did that work out for him?
I talked him off the ledge.
Good, I'm glad.
Yeah, and we started talking about just a more simple, straightforward protection, and I think he ended up going with that.
Yeah, that's kind of the caution flag I wanted to throw out there on the VIX as well. I agree with everything you guys said. The VIX is a very interesting product and certainly has its use cases, but it kind of gets overplayed a lot in the media and everywhere else. The fear gauge resonates a lot with people, so it gets bandied about quite often in scenarios where it really shouldn't be. And so people come to sites like mine and radio programs like this, or companies like Sogo or guys like Dan, and they look for hedging with the VIX, and they think of the VIX as this great hedging tool, even on individual names like Apple, which is, of course, an entirely different discussion in and of itself. But as John outlined, really, the VIX is a unique product, and it's for a unique purpose. If you really believe that the bottom is going to fall out of the market and that we're really going to have a severe correction, I hate to use that overused term black swan, but something along those lines, a very dramatic movement in the market, that's where we see VIX really outperform. That's where we see VIX calls, VIX call spreads, things like that really pop and really have a dramatic payout. The problem is the rest of the time when they kind of just vacillate. And sometimes they perform, sometimes they don't. As Dan and John said, 87% of the claims being paid out. That's probably a generous assumption. And a lot of the markets where you have some choppy markets, one day you're up, one day you're down, those are the times when VIX as a hedge is really a dubious concept, because VIX is a tradable product. VIX is a future that is traded on the CFE, and there's options traded on that future. So and of course, there's a entire universe of products that exists around the VIX as well, which maybe we'll get to in a few minutes. And all of these things are pulling on the VIX in different directions. So the VIX really has many masters. It's not just this pure one-to-one thing. S&P goes up, VIX goes down. A lot goes into that calculation aside from that. You could have a day where the S&P is trending down a little bit, but guess what? A lot of customers are coming in to the SPX, which is the volatility level that the VIX is calculated off of. Remember, a VIX is the implied volatility of front-month SPX options, and someone could be coming in, a lot of customers could be coming in and aggressively selling options in the SPX. Guess what? The vol in the SPX is going to go down, and the VIX is going to go down, regardless of what is going on in the S&P. So VIX as your only hedge to your portfolio, I would probably caution against that unless you really have a very deep concern for very dramatic sell-offs, in which case it may work. But what we've seen a lot of people doing, actually, and I don't know, Dan or John, maybe you want to jump in on this as well, is using VIX in conjunction with other more traditional hedges. So let's say you're doing what we talked about in this show already. You're taking some of our defensive strategies. You're buying a put, or you're buying a put spread. You have a very broad portfolio with a lot of exposure to the S&P. So you're buying S&P, maybe SPY, maybe SPX puts. Probably for the bulk of the listeners of this show, you're buying S&P puts. You're buying SPY puts. So you're buying SPY puts to hedge your portfolio. Now you're concerned, maybe you start seeing the market vacillating a little bit. You're protected with your put spread. Now you start thinking, well, perhaps if we have a really near-term retracement, obviously you'd close out your put spread and buy a put, but also you can look at adding a VIX call or a VIX call spread as a kicker to that. I'm curious, John or Dan, you have everybody calling you up asking to start using these combinations of strategies so that way you get the very near-term protection of a more one-to-one type thing like a put or a put spread, but you also have this kind of VIX kicker looking out in the wings.
Unfortunately, not enough. I mean, a lot of the people, like I said, a lot of the people who come to me kind of fall in the camp of the person I just described. They hear about how sexy the VIX is and they think it's like a one-stop shop, it just does everything, and it doesn't. So that's the thing that I spend a lot of my time doing with investors, is setting up these more sophisticated hedging strategies, things that do incorporate things like the VIX and more traditional hedging. A lot of times people don't come to me looking for that, but we end up having that conversation anyway.
You should have set up the RIA shingle and be done with it, Dan.
Yeah.
But, I think all of us on this show, and John, I don't want to speak for you, but I'm assuming you probably fall into this camp as well. All of us are former market makers. I think all of us, for the most part, probably fall into the camp of the more direct hedge is preferable. The put spread / whatever you're doing in the actual underlying you're trading versus relying on VIX. But VIX can have some interesting side benefits. Is that where you fall as well, John, in the more direct hedge, the puts and the put spreads versus some of these volatility products?
Yeah, I mean, I certainly do. And the one thing that we get all the time here is we get a lot of questions about these, and a lot of customers calling up and wanting to use these leveraged or these inverse ETFs. And when I hear that, I have to really talk to the customer and really let them know, because most customers, they don't understand the point that these leveraged ETFs, they may replicate the index over a day or two, but over the long run, they are what we call value destructors, or value destruction occurs. So these options, these leverage or inverse ETFs, they are products that you should only use as a customer because they're very path dependent. So if you believe the market is going to go straight down, they're good. But if you're counting on volatility, they're terrible products to use. And we try to steer customers away from using them. And another reason is because the margin on these leveraged and these leveraged inverse ETFs is 2 or 3 times, the S&P. So there's higher margin requirements. So that's a little twist on what kind of questions that we get here.
Yeah, I think the most infamous example of that is TVIX. That is, of course, the Velocity Shares 2x levered VIX ETN, and that one has just been a disaster. And if you need an example of why you shouldn't be trading these things, why you should instead be trading the direct VIX options or things like that, just look at TVIX, or you can Google, listeners, TVIX, TVIX is the ticker symbol, into Google. You'll see a lot of stories about what happened there, how they really mismanaged that fund. A massive influx of funds came into TVIX and really just knocked the train off the rails, and the thing has never really recovered. They've had to split it. It hasn't moved at all in conjunction with volatility. It's really kind of its own beast now. That's an extreme example, but it's a perfect example of why you probably shouldn't be trading these things, because these are, at the end of the day, structured products. And in order to trade one of these accurately and effectively, you really have to know how these things are structured. And that usually is a very convoluted thing to find out. And they're trying to replicate something that often you can do yourself with options in a much more effective fashion than using one of these products. And usually they're charging high fees or incorporating those fees in there somewhere to do it. And it's usually, at the end of the day, not a great value proposition. I know it's enticing to say, wow, I can just buy this. And these in many ways are kind of the poor man's options. People see these levered ETFs as a way to get leverage without having to learn about options and using options. But of course, you get what you pay for. If you're buying a poor man's options, you're going to get the returns of a poor man's option, if not worse. So at the end of the day, if you're listening to a show like this, you obviously have some interest in options. You're much better off using option strategies to replicate whatever you want to do in the underlying, whether you want to have these levered returns or levered protection, whatever the case may be, rather than turning to one of these obscure structured products to do that for you. Dan, anything to add on the volatility or these ETNs floating around, or perhaps any of these structured products?
No, I mean, I think you really hit the nail right on the head, saying you need to understand how they're structured. And, again, just to hammer away at this idea of stay within your own sophistication level. A lot of people read something online by some of these guys who write a lot about the VIX, like Luby, VIX and More blog, which is a great blog. He talks about some of these really, really fine-tuned details that are very, very important to the product, that if you're going to trade them, you need to understand. But people then just focus on these really, really fine-tuned details. And, you're looking at like a little speck on a tree instead of the whole forest. So, yeah, education makes you a successful trader.
All right, to wrap up today for the basic training segment anyway, we hit on defensive strategies and ways you can use options to defend your underlying stock portfolio. Of course, there's the very basic, the protective put, and the covered call. Go back and listen to episodes 3 and 4 again if you want more specifics on those. But I think the real interesting position for a lot of you out there is the collar. And that, of course, is where you buy a protective put against your underlying stock position and also simultaneously write a covered call against that position. And now you have literally a collared position. If a stock goes up, if a stock goes down, you have options kicking in at those levels, hence the name the collar. And I think for a lot of you out there who want protection but are worried about how to pay for it and how to keep affording it on an ongoing basis, the collar is an ideal strategy for you. If you want to learn more about how to construct collars or how they work, of course, you can surf on over to theoptionsinsider.com. Just search for collar. A lot of great stuff up there, including that study John talked about where we run through how collars can actually outperform being along the underlying in a lot of different environments, certainly on a risk-adjusted basis, and even on a total return basis. And the OIC has a great study on that, looking at the collars on the Qs and the Russell and a variety of other indices and how they've performed over different periods. You can find that on our site as well. Of course, you can always call up a guy like Dan over at Market Taker Mentoring, and he could walk you through the finer points of collars, or just surf on over to Sogo Trade, open up an account, and have a guy like John walk you through the finer points of collars. However you want to do it, collars are certainly an interesting tool that should be in your trading toolbox. Last but not least, we hit a little bit on the VIX and volatility products. The key takeaway for that, for at least most of our listeners out there, is really you should be considering some of the more direct defensive strategies that we discussed today, like the puts, like the put spreads, like the collars, and leave the VIX to you become a little bit more sophisticated so you can understand the nuances of that product a little bit better, and B, if you are going to start using it, certainly don't rely on it as your only hedge. Perhaps use it in conjunction with another defensive strategy so you can get that bang for your buck when the underlying sells off dramatically and volatility increases, but in other scenarios, you're not completely reliant on it as your only means of protection. So there you go, some cool takeaways for today's episode. If you want to learn more, of course, we talked about synthetics as well. Go back to episode 18 for the joys of synthetics. A lot of great archived episodes there in the Options Bootcamp archives. You can go back and check out all of those as well at any time to learn more about any of the strategies we hit on today or in previous episodes. But now we have to keep on rolling and give you, the listener, a chance to sound off on the show. Yes, it's time once again for the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, and welcome to the mail call segment. This is, of course, where you, the listener, get your chance to join us on the old drill instructor squad. First off is a well-timed or perhaps poorly timed, depending on your perspective, question from Miss Tina K. She writes, when, and in parentheses, if, should I consider volatility products as a hedge? Well, Tina, we just hit on that, so listen to today's episode, of course, for more information on that. But in a nutshell, I think all of us, and then Dan and John as well, really think that volatility products as your sole hedge are not the right way to go, particularly for the audience of this program, newcomers to the options realm. They are more sophisticated products. They require a certain degree of understanding, a certain degree of nuance to really trade properly and understand how they work, understand how they're calculated. There's things that go into the VIX like rolls, like settlements, that really make it a much more obtuse product than it may seem on the surface. And if you don't understand that, it's really going to be hard to use it effectively as a hedge. So I think listen to this episode today and do what we recommend here today. Hedge with puts, put spreads, more collars, more direct types of defensive strategies. And if you're still interested in the VIX, you have a longer term upside bias perhaps in the volatility, and in VIX, perhaps you want to buy some VIX calls or VIX verticals, things like that. Just remember to pay attention to how this product actually works. Remember, it doesn't key off the VIX cash. It keys off of the VIX futures, which is another discussion entirely. And another reason why the VIX is perhaps not suitable for the options beginner. John or Dan, anything to add to this for our friend Miss Tina K here?
I just want to add one thing. The idea of using volatility products as a hedge, that was a wonderful answer, and we've gone through it during the show. But as far as other hedges that customers feel comfortable with, when they say, should I hedge or when should I hedge, I always say, be more conservative, always hedge. don't let high implied volatility scare you away. Everyone remembers, I've said this in the past, when the IV went to 80 during the financial crisis, buying premium protection actually was a winner. Short term it was. So because the market was moving 5% at a clip. So what I always tell customers is that when implied volatility is high, it may be a buy. And when implied volatility as a hedge or protection, but also when it's unusually low, I often personally think that these are the riskiest times, or more clearly foreshadowing risky times ahead. So when you see volatility very low, that sometimes is what I call danger, the VIX is crashing type of events. And in 2007, the VIX was extraordinarily low. And guess what? A year later or months later, we had the 2008 crisis. So, for customers that are out there, unless you're using speculative monies, I would try to have some hedge on almost at all times.
Yes, well said, sir. And now, next up, we have a question from the calm, cool, collected Mr. Zen. I like that handle. And he says, can you explain the difference between iron condors and iron butterflies? And Dan, I can hear you champing at the bit there with your whistle in hand. But before you do that, let me just toss to our friend Mr. Zen here to the episode where we discussed this in great detail. This would be episode 14, which came out way back on January 10th of this year, called Advanced Spread. So if you want to learn more about the specifics of this question in a lot more detail in an entire episode, then surf on over to the Advanced Spreads episode on the Options Insider or in iTunes. We get into a lot of the spreads with wings, which is exactly what you're talking about here. But Dan, for those who either haven't listened to that episode or just tuning in today and listening to this question, what can you tell our pal, Mr. Zen, here?
Well, one's a bird, one's an insect. No, I'm just kidding. I couldn't resist. I know it's obnoxious, but I just couldn't resist.
It is pretty obnoxious, yes.
So basically, it's this. Both are a pair of credit spreads. Both consist of a put credit spread and a call credit spread. The difference is really, really simple. With the iron butterfly, the short options share a strike. With the iron condor, there are no shared strikes. There are a total of 4 strikes. So let's go like this. Let's start out with the iron condor. One could construct that by buying, say, the 45 puts and selling the 50 puts. There's your put credit spread. And then going up another strike and selling the 55 calls and buying the 60 calls. There's your call credit spread. So you have 4 strikes involved, right? The iron butterfly, one can construct a similar position by buying, say, the 45 puts and selling the 50 puts, and then selling the 50 calls and buying the 55 calls. So see, you still have that same put spread, but you have the call credit spread that shares the same short strike as the put credit spread. So, it's they're very, very similar positions. The iron butterfly would have a tighter range that the stock would need to stay within in order to remain profitable. Typically, I like to tell my students butterflies and iron butterflies typically require a time horizon of 2 weeks or less, where an iron condor, you can go out, 4 or 5 weeks if you'd like. So those are really the main differences.
All right, thank you for that, Dan. And last up here in the old mail bag, we have a question from Mr. Alan O. And he writes, what do the drill instructors think of the minis so far? Are they worth exploring for basic options traders? Good question, Mr. Allen O. And this is an interesting one because actually about exactly a year ago, Dan's getting ready as we speak to head on off to Las Vegas for the Options Industry Conference. And this time a year ago at the conference, all of the talk was about minis. And the minis as they pertain to Apple. If you're not familiar with these mini contracts, these are 1/10 size equity options, and they're only listed on a handful of the major names like Apple and Google and things like that. So, but you can obviously see the benefit of them. If you look at options on Apple right now, they're extremely expensive. If you were to cut that price by 1/10, then all of a sudden you are trading a product that's much more affordable for the average investor. And that was really the impetus behind these. Of course, it took a while to get the product approved and launched, and now they launched at the end of March. So you've had about a month or so now these minis listed. And so far, for all the hopes and the vested interest people had in these products really doing well and thinking these are really going to be the product that was going to turn around the volume story for 2013, so far I think I have to say they've underperformed. The volume in them is scant, to say the least. People are having a hard time executing in them. There's a lot of questions about them. They're 1/10 size contracts. How do the commissions work out? Things like that. We're getting that question on an almost daily basis at the Options Insider. And also, if you look at them, first off, they're hard to find. A lot of brokerage platforms make them very difficult to find. A lot of analytics programs as well. Typically, you have to do things like click on an alternate tab or things like that to even see the options chain for these things. So they're difficult to find. And when you do find them, because so few people are trading them, so few people are making markets in them, the spreads are atrocious. They're 10, 15, 20%, perhaps even more larger and wider than the traditional equity options that they're based off of. So you really have to have a strong interest in trading the minis in order to do so, because right now you're getting hurt on spreads, you're getting hurt on commissions, and there's very few outlets where you can even find these things right now. So right now, Alan O, I probably would have to weigh down on the side of wait and see. It's really still early in the mini ball game. A lot of brokers are still working out how they're going to implement these things, how they're going to price them. The exchanges and the market makers are all figuring out how they're going to provide liquidity, what products to add next, things like that. So it's still very early days until we see some more liquidity, so we see some more volume, until we start seeing the spreads tighten up a little bit out there in the minis. I really have to recommend, unless you have a very specific need for these things, that I would stay clear of the minis. And John, I know you guys are working on implementing the minis over there right now and dealing with a lot of these issues. What's your take so far on the minis and how they're unfolding and whether they're striking a chord with the retail public or not?
Well, the number one concern we have with the minis is always, our customers, to make sure they understand them. And we took a wait and see approach. And the one thing I just wanted to reiterate and touch on, which I'm very disappointed in as a trader, the market makers, and I'm a very pro market maker employee at my firm. But the markets are really very wide. And the thing that really distresses me is that if you see a market that's 1 to 105 in Apple, and then you see the equivalent, 1 to a half, I mean, the market should be the same. I'm not sure. They made a big push to have the ISE and these big exchanges list them, and now they're making these really, really wide markets. And that doesn't make too much sense to me, because the market makers can hedge these things with the regulars. So it's not like they can't hedge them. So we're taking a wait-and-see approach, and so far I think you're right. It's been kind of a mixed bag. But if they catch on, we have the programming in place, and we will put them on the platform. But as of right now, we're still kind of taking a backseat approach so far.
Yeah, I'm with you there, John. I was kind of surprised to see these spreads be as wide as they are in the beginning. Obviously, liquidity helps that and helps to tighten the spreads up, but you're right. These aren't completely foreign products. They can hedge with the big contracts. I would think the market makers would jump all over this as an added way to spread off some risk and to really trade these things kind of aggressively. And perhaps we're seeing some of the blowback now in the market making community just from the fact that from all the years we've spent of incentives like payment for order flow and things like that, that's really decimated the market making community. And the community as a whole is much smaller now than it was when you and I and Dan were participating in it 10 to 15 years ago. It's contracted considerably, and maybe we're starting to see the ramifications of that now. There's fewer players out there standing in the pits and standing in the bins making markets, and maybe this is a result. So, yeah, you're right. I was kind of scratching my head about that for a little bit, too, why these came out of the gate so wide when they were so aggressively promoted and everyone was really pinning so many hopes on these. Didn't seem to really follow through on the market making side for whatever reason. Dan, anything to add on this? I know any of your clients coming to you saying, hey, what about these minis? Any interest at all from your client side?
Yeah, I mean, they can be potentially helpful. I mean, like anything else, liquidity is the key, but potentially they can be pretty helpful because the whole reason a lot of people like to trade really basic option positions on stocks like Apple, for example, is that you can't afford to buy the shares, so instead you buy a call as a proxy. And geez, at some point, it gets to the point where you can't afford to buy the options if you're a little guy. And so they can be helpful, particularly to the very small investor, but I want to see a little bit more liquidity before encouraging people to consider them.
There you have it, listeners. It is unanimous from the Options Bootcamp Drill Instructor Squad. Stay clear of the minis until these things tighten up a little bit and some of the other behind-the-scenes mechanisms are worked out to make them a much more viable and profitable and easy to trade product for you. And until it gets to that point, I really would stay clear. All right, that's going to do it for the mail call segment, and unfortunately, that's going to do it for this episode of Options Bootcamp. I, of course, want to thank my cohorts, my partners in crime, John and Dan, for joining me on the program today. And Dan, starting with you, what is coming up in the land of market taker mentoring that may interest the folks at home?
Oh boy, there is always something new here at Market Taker Mentoring. We had a really, really huge amount of interest over the last 2 months in our online education series. And boy, oh boy, particularly this month, we had more people sign up than ever before. And it kind of makes sense. The market's been up and people are more and more interested in options, and so we're really, really excited to have that influx of students into our online education series.
Glad to hear it. If you'd like to learn more about what Dan has going on, then surf on over to markettakermentoring.com and see for yourself. And of course, I also want to thank John and the folks over at Sogo Trade for joining us on this program and for bringing this fine program to you folks at home. So, John, what is coming up in the land of Sogo Trade? What are you guys working on that may interest our listeners, the folks at home?
Well, the one thing that we're working on is that we're trying to develop a new education type of website for our customers. We have a new equity screener in there. And our customer and the listeners can use the option ideas here, coupled with the equity ideas provided in the screener, and maybe make some great trades there. I'm trying again to write some more articles for the Option Insider. We have our Sogo Trade blog on the pre-login page, and of course we're on Facebook, Twitter, and my Twitter is Sogo Trade Option.
So will this new educational site, will this be a sub-site of the sogotrade.com domain, or will it be a separate Sogo Trade educational entity? How will people find this? They'll click on this at the Sogo Trade?
We're just trying to, the education is so important, and I know we keep mentioning it over and over again, and we just want to put our money where our mouth is, and we just want to try to just, try to incorporate more educational tools and articles and maybe links and maybe video blogs or whatever the case might be, but we just want to make it more robust. We're finding that a lot of our customers are really craving more education. That's why we're doing the podcast and doing more articles. So it's in the beginning stages, but we're hopefully roll it out in the next few months.
And if you'd like to see more of the educational material for yourself, you should be Sogo Trade customers already. If you're not, then surf on over to sogotrade.com, and you'll see the education tab on the top right of the page there. You'll see the overview, the basics, which is all the stuff we talk about on this show all the time, mechanics, and of course, options education, and John's blog there, the Sogo blog. So a lot of things you can do to follow up with the topics and the different strategies and ideas we discuss here on Options Bootcamp all the time. We're just shoot John an email over. John, what's your email address again for the folks at home? They want to ask you a question directly.
It is jcritchley, CRITCHLEY, at sogotrade.com.
There you go, listeners. You can send John an email directly and say, hey, John, how do I use the Sogo Trade platform to put on a collar, or what are the commissions for a vertical put spread, things like that. So by all means, reach out to him, reach out to Dan, or find us over at theoptionsinsider.com, where you can listen to the archived episodes of this and every other program on the Options Insider Radio Network. And of course, if you're going to be in Chicago on May 15th, we'd love to see you there for the Options Insider premiere Unusual Activity Forum at the Chicago Board Options Exchange. Surf on over to theoptionsinsider.com/events to learn more. And on behalf of John and Dan and myself, we want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program, and of course for writing in such great questions. And we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.